it could be somewhat negative that we're seeing the USDA not respond.
We're doing events like we're going to be doing with Comstock in, I think it's February coming up. And it's just right now, it's we've kind of gotten into a rhythm and we like doing what we're doing. And it's been really rewarding. So for right now, we're kind of just rolling with it and having fun.
If we don't drive home the negative consequences of not doing it, and we don't make people aware of those things that they're not doing that can help their culture and their business, they're not going to do it.
Come with an open mind. If you're a person who's hesitant to social media, I definitely understand that some people do not see a value in it. And I do think social media can be a massive waste of time if you're not using it correctly. So if you're skeptical, that is fine with me.
Kind of the stereotypical State Farm corn and soybeans. We just rotate every year. So just shy of 2,000 acres.
It sounds awesome. I don't know where I'm in Des Moines, Iowa. I enjoy telling stories and telling our story and telling what happened to us business-wise. You know, there was a lot of good and positive things. There's been negative things. There's been a lot of mistakes. You know, a lot of what we learned from is like, oh, we screwed that up. We could have done that better.
Family Farm Masterclass that'll be coming up in February in Des Moines, Iowa. Hi, everybody. Welcome back to the Comstock Report. I'm Marlin Bohling with you. Always a pleasure to visit with you about ag-related topics. Today, we're going to focus on what happened in the markets at midweek with a little extra help from Joe Camp of Comstock Investments. Well, Joe, thank you for joining us. We had a little bit of a downward turn, I guess you would say, in the grain markets. Cattle, it was interesting. Live cattle kind of held their own. Feeders, maybe not so much. And hogs are just kind of topsy-turvy here. Let's talk about the grain market first, if you don't mind. Did anything significant happen on the grains? I see where wheat made a big move to the downside today.
Wheat was the leader lower, breaking early enough to eventually weigh on corn and soybeans. You've got more talk about back to sagging values internationally. The Russian market has led the way back lower. It did provide some slight strength on the way up. We've got our own issues here at home domestically, weather-wise, to deal with. These threats of winter kill maybe being put behind us. The conversation about there being snow cover in a lot of places to help out, and then just not far ahead, a shift towards into the 6 to 10 day forecast, at least a warmer trend. We had a look at the condition ratings for various states, down for Texas, not all that bad for Kansas. And so just some easing of values, though, generally after a good 5 or 6 weeks up. And that could be linked to the corn performance as well, where you have, nothing bearish about having just made new highs for the move this week. But less bullish was the reversal down from the early strength this morning and the settlement for March futures back below $5. An active spread trade that was ultimately a weaker spread, some maybe foreshadowing of what we're ahead against as we approach the March delivery period at the end of the month. Maybe this thought that the end users, the merchandisers, have enough coverage and won't be necessarily scrambling for it in the couple of weeks as we lead into delivery. And so that could weaken things further in what has been a bear spread that's come out quite considerably over these last several weeks on corn, spreading among the markets as well. That could be true of the livestock too, some reversal of earlier in the week, that strength. And also you mentioned with the mixed live cattle, higher, feeder cattle lower, that's just a simple reversal of how they were flipped yesterday. So, from all sides, nothing out of control, no real helpful guidance from outside financial markets, and rather quiet, tentative type of trade approach.
Let's talk about the corn market for a second here. You talked about watching the spread activity. For someone that's maybe relatively new to working with futures and options, can you explain what it is that you're watching there? You mentioned a bear spread. Explain what that is for someone that may not know.
Yeah, bear spread here on today's action and leading up to today, these past several weeks, because the nearby contract is not keeping pace with the deferred months, the May and later. March is still our nearby contract. It's just recently turned back above $5, which was a positive. And to mention, again, new highs for the move, that's a friendly feature of the market. Yet when it comes along with this bear spread, with the later contracts coming up faster in this case, that can be a more negative look or an indication of a possible topping out of action. And it relates to one, where the speculative positions are stacked up. We know that the commodity trading funds, like like to watch so closely, they're often going to be bunched in the nearby contracts. And so if that contract itself isn't keeping up, it could be a suggestion of an unwillingness for this pretty aggressive, in the case of corn, length from managed money to be rolled forward into the later months. And then I mentioned just briefly the commercial end, that you head into delivery, and it's important whether or not those spreads are going to be the deciding factor for merchandisers that are going to execute against the nearby and move that corn down along the line, or roll short hedges forward into the May. And lately, there's been this idea that the end user, again, the buyers, the elevators, have bought a lot of corn here recently. We know they bought a lot in January. We know that's an important feature of the market, that the speculators have been buying from the producers in a bigger way. And now there's this idea that there's not, again, a scrambling for coverage against the soon-to-be expiring March contract. And this signals that they have some comfort in the amount of time that they have to get these next purchases whenever they are going to be bought. And that, for me, is the sign of why we're seeing this spread weaken. It can be a decision for producers as well, though. If you're hedged short in the March, we have come out some 10 cents or so on the March-May corn spread recently, again, a bear spread, because the May has held up and advanced better than the March. You could roll those nearby shorts out forward to May and still think that now you might have more time to have those basis levels come in and to complete the sale later, when those commercial buyers that we've mentioned get past that delivery window and then are into a period eventually where they need to bid up for what's left of the old crop.
Now, you're located in Illinois, right in the heart of the Corn Belt. I'm hearing stories that the basis out in the country is really falling apart early this year. Is that true in your case, in your area, or not?
Yes and no. And it's true in the sense that we're a lot weaker over the past several weeks, and that fits with the rising board values, that you have futures go up, and that being an incentive for cash corn to move from farmers' hands into the commercial system. And that you come to a point now where, just like we're talking about, those buyers don't have to aggressively bid against the nearby March contract for the spot bid to be as strong as it might eventually be again later. But it's also something that has to be put into perspective, because you could say a lot of areas are also a lot better off for this time of the year than they have been in years past. So weaker lately, but not so much weaker historically for what we'd expect at this time of the year. We're still beneficial coming into the new calendar year with what were hot markets all around, whether it's the river demand staying improved for longer. We had a record month for river shipments in December, really working that corn down into the trade pipeline. And then Illinois is actually a really strong supplier of those corn bushels to Mexico along the rail system, for one. And so that helps. And then the ethanol storyline, whereas fitting with the general trend that I just mentioned, we're weaker lately, we're also in a spot where ethanol production as a whole has been at record levels, and it's better than maybe we might normally expect for this time of the year. So it is a pause in the action, something where we're hunkering down and wondering if we could get out of this month, get into the delivery period for that March contract, and then we could see basis improve. Basis and spreads, I mean, it's good that we're talking about those back to back. They really work hand in hand to signal what the position out there is. And the position for the farmers is more heavily sold than usual here coming in to this latter half of February. And that maybe being something that would lead to these bear spreads lead to the sagging basis, but also eventually maybe lead to further upside, because that's also the case where it's different, that the farmers have sold a lot of old crop grain, and that might be less of a headwind if the spec crowd is going to resume buying from here.
Well, considering that more of the South American soybean crop, the new crop, is coming online now, and they're getting deeper and deeper into harvest, do you think the soybean market is grasping at straws right now just to hang on?
Yeah, and that was evidenced again last week by the diverging movements in corn being up for the week and soybeans being lower. It looked like it was going to turn out the opposite after the crop report last week. And we talked about this in follow-up of that report, that it was more of a negative set of numbers for corn. Why? Because USDA did not raise U.S. demand like we thought they should on exports and ethanol. That kept the carryout higher than anticipated, and maybe more particularly the negativity over China long term, and the reduced Chinese import forecast for corn, whereas on the soybeans, they were relatively better off after report day, at least immediately, because USDA did not up the Brazilian crop, and they did reduce Argentina's numbers. But by the end of the week, that the trend continued, where corn was the stronger one and soybeans were weaker. And I think that goes back to directly how you set up the question, which is the difference in trade performance. Whereas last week we had 3 of those daily flash sales pop up for corn, but we did have a soybean sale, but a small one, and it was the first of its kind in almost a month. It is that time of the year where the big buyers like China, but others as well, are moving their business down to the southern hemisphere. And we know with the recent catch up in the Brazilian harvest numbers, that was shown last week, where they have all but caught up or even exceeded last year and their 5-year average for soybean harvest. Their pipeline is filling, and filling fast, and they've got a lot of beans to offer the world, and that pushes, at least out for now, the U.S. demand on the trade front, which is relatively weaker on the beans, still stronger on the potential for trade and the outlook there for corn.
The wheat market sold off pretty hard here on Wednesday, but I'm looking at some wheat charts. Doesn't look like it broke that uptrend line, though. So far, it appears to be safe, isn't it?
For now, we're looking at this 6-week turn up as a potential trend breaker. The primary trend, we're still stuck in a bearish type of move down from the past couple of years. The spike in 2022 following the invasion of Ukraine, and then the deflation that we've observed for wheat. Well, then a little bit of a bounce late last fall. It looked a lot better for wheat futures, ultimately failing, though, to turn up that broader primary trend. And so sinking back lower into the first part of the year. Now the latest move up possibly is a secondary type of reversal that can get us, if we can get past the fall highs, we're talking about nearby Chicago wheat above about 617 from early October. Then that's going to go a long way, and maybe turning the attitude of the technical trader. And when we think about technical traders, they're going to be, a big portion of those commodity trading funds and the managed money folks that have a lot of money behind their computer algorithms. If we start to see that technical upside triggered in a more bullish fashion, that could be what it takes to take wheat from being a still net short commodity held by the funds to flip it into a net long like corn and soybeans, but remains to be seen.
Well, let's talk about livestock here. I mentioned the divergence between live cattle and feeders. What happened there?
For one, you got to a point where, because live cattle were the weaker link earlier on in the week, there has to be some reversion because of the live cattle being so close to its expiration or further into the delivery period now for February, and even more discounted spread down to April. It's the opposite of the corn market, where we talk about there being some carry premium with the deferred spreads higher than the nearby. In the live cattle right now, it's the nearby contract that's the top of the curve, or at least relative to the next couple of contracts. And so there's this question of, into the end of the month, how do we see convergence? And that's convergence between futures prices and the cash market. If you look at where February futures settled at just short of 198, I mean, even some of the worst cash type indications down to 202 would leave a $4 to $5 discount from where we see that cash. And it can be the cash that backs off further. But at this point, we'd also see some support, at least for now, and especially until we get some better cash guidance in this market. We know it's going to be slow again this week. That's another component of the trade, that we've got these weather concerns with these winter storms. So the supply side is holding back ready cattle, but you've also got some pullback here all of a sudden lately on the buyer end, where they're trying to slow things down. We have seen the retreat in beef prices. They'd like to pull some of that from the market, get a bounce there, and at least at the moment, use the lower futures prices and the lower cutout as an excuse to try to pull things back on the cash end. So convergence is very much an issue in the live cattle. The feeder cattle, a few different things going for it, whereas they've been the stronger cash type market, holding up better relative to the live cattle recently. There can be some headline type reaction that is evident last week into this week. Another screwworm infection announced in the news last week into the weekend. Today, it could be somewhat negative that we're seeing the USDA not respond by closing the border again to feeder cattle imports from Mexico, like maybe had been earlier anticipated. And that leans more negative if we're going to continue to resume that heavy supply of Mexican feeder cattle into the market. But at the end of the day as well, just a simple unwinding of the spread that was on yesterday, and really rather minimal types of move, even if up for live and down for feeders.
And then you have the hogs. Wow, what a move they had in the hogs today. If I'm looking correctly here, Joe, it looks like we gapped lower on the lean hog trade. This is after we gapped higher last week about this time, and their gap is almost in the same spot. I mean, it's technically not an island top, but boy, it's close to one. How dangerous is that on the chart?
Yeah, to see the gap lower and then the continuation, the fall below the mid-range, just say the 20-day moving average after there had been an early upside rebound attempt. You open those gaps and you wonder if, well, do we need to go fill those pretty quickly? Or is that the gap, the start of something else, like you talk about islands or a measuring type of gap that takes us quite a bit further? In this case, not long ago, we were talking about a potential bearish head and shoulders pattern that was technically negated by the move to new highs. But given that those new highs were marked out without the real show of conviction, whether it's higher volume or momentum keeping up pace, that was some bearish divergence that ultimately seemed to have played itself out in today's trade. And that can be very similar, or a preview of what we're looking at as a vulnerability for corn again, that the funds are so heavily long in these markets. If they make new highs, but then look around and they say, well, okay, who's going to join me in buying now? And they don't have that, then it's just as quickly a rush to the exits and something that snowballs into hitting stops and a massive liquidation event, like it seemed like developed here on today's hog trade.
You talked about it taking out the 20-day moving average. Right now, it's just barely above the 50-day moving average. It seems like once it crosses that line, oftentimes it'll stay that way, maybe for months, above or below that line. It doesn't like to cross it very often.
Yeah, that seems how it looks to me as well. Next stop would be not long ago at the start of this month. We had a low that was just a poke below 100. That's a really critical mark. I'm talking about now the June contracts, some of these summer contracts that we're eyeing out technically in a bigger way. Below that, you've got some lows from just the very beginning of the year, a hair under 98. And that's the broader uptrend that we're in. The risk is that you fall back under 100 convincingly out in these later contracts, and it's going to be a more sustained bearish type of technical trend all of a sudden again. We'll see. The fundamentals can very quickly get us back to being bullish. We know that production is going to decline into at least the first half of the summer. We talk with producers out there that are dealing with disease issues that could potentially only exacerbate some of the break lower in output potential. But the wild card is going to remain demand, as with any market, not just fundamental demand from exports and the impact of the dollar, but investment demand, and whether or not the trading funds are going to want to stay long here in a market that maybe is showing more signs of topping.
Excellent stuff. One quick question before I let you go. Did the higher dollar, did that play a negative role in commodities at all today?
Yeah, it seemed that it's not breaking further, sours in some way this broader inflation trade that we've got on. And to mention that the managed money is as long as they are in corn and moderately, but still on the net bullish soybeans, but on the livestock, back to them aggressively net long there. They've been supported by also the index funds coming in and rotating big capital, long only type of massive passive investments into the commodity space as a whole. But just as similar as to the discretionary funds, they look around and say, do we need to continue, or is that enough for now? And that seems to be more the action when you don't have the support of a continued decline in the dollar. They're going to put these buy orders on pause for the moment. It seems that way in a lot of markets, whether it's the metals flipping back low or the crude oil coming off of its highs. Just not the same type of enthusiasm for commodities as we've had leading up to today.
Well, Joe, great information. Always a pleasure to visit with you about what happens in the markets, usually at midweek like today. And I always look forward to our discussions. And I look forward to talking with you this weekend, too. We're going to have our Family Farm Masterclass event. That's coming up in Des Moines. It'll be at the Marriott Des Moines downtown. And, of course, if our viewers out there have already registered, we thank them for that. Might be able to squeeze one or two in yet. If you still want to take part, go to our website, comstock.com. That's 2 M's. And anyway, check on the upper right-hand corner. There'll be a link that says Masterclass. You can click on that, get all the details, all the agenda, who the speakers are. And if you want to attend, you can register there, and might even be able to make accommodations yet. I don't know. Depends on the weather. But anyway, we look forward to seeing everybody there. And Joe, are you going to make it? I hope to see you there too.
I'm ready. I'm looking forward to it, Marlin. I'll see you there.
All right. I'll be there too. So I look forward to seeing all of you there. That will be coming up on the 21st and 22nd in Des Moines. Looking forward to it. We'll talk about it more next week. That'll do it for this episode. Thanks again for joining us. For producer Breanne Jenkins, I'm Marlin Bohling, and we'll catch you next time here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.